today I'm super thrilled to talk about training and development and matters more than ever. And I'm thrilled to also have Dustin Owen. We all know Dustin from not only his posts, but also from his Loan Officer podcast. He has 1 million downloads, so I'm jealous, Dustin, to say the least, because I know the work that's involved with it. He has had a long career in mortgage banking with Waterstone and Lower, and now I'm thrilled to talk to Dustin about this important topic. Hi, Dustin.
What's going on, Pat? Thanks for having me.
Well, I'm thrilled to have you. You write fabulous LinkedIn posts that I definitely read all the time, and I'm curious about this whole issue. But before we jump into that, I want to hear, how did you get into our world of mortgage banking, and what was that first leap that you made?
Like most of us, I did not
Yeah.
grow up even knowing what a mortgage banker was or what a career in mortgage would even mean. I have a degree in advertising and public relations. I worked in television advertising right out of college, and I was actually unhappily employed selling local TV advertising in West
Okay.
Palm Beach, Florida. And I was helping my childhood best friend who was graduating about 3 years after me in college. I was helping him prepare for job interviews. And
Mm,
his degrees in finance, personal finance was always a passion of mine, but it wasn't what I pursued as for my undergrad. And as I'm helping Brian look for these jobs, because really I hated my job, and I was like, what else am I going to do to kill some time? I kept on coming across jobs, whether it was an account executive, it was a mortgage banker, it could have been a life insurance salesperson, a financial
mm,
advisor. But I was like, wait a minute, I'm still selling, I'm still marketing, I'm still helping people in consulting, which is what I loved about advertising. It still
mm.
has a entrepreneurial feel to it, but it works more in personal finance. I'm like, that sounds like me. That sounds like what I would like. And the long story short is I, through a friend of a friend, get introduced to a company that you're probably familiar with. I mean, they've been long defunct, but
Sure.
Home Bank Mortgage Corporation out
Oh,
of
yeah.
Atlanta, Georgia. Home Bank
Yeah.
had one of the best training programs.
You did.
I lived in West Palm at the time. They had a solid footprint in South Florida. The friend of a friend got me an interview. I did well in the interview and they hired me. And what was really cool is I had found some interviews of my own and I had two job opportunities. I had the home bank opportunity and I had this other opportunity. Well, when I declined the other opportunity, I said to them, hey, my best friend just graduated with a degree in finance. I think you should interview him. And lo and
Oh.
behold, he ended up taking that job that I turned down and I took the home bank opportunity. That was 22 years ago, almost to the date that we're recording this.
Is that right? Yeah, I remember Pat Flood for sure. And so he was really an icon in our industry with what he was doing in the training program. It's ironic that he was really way before his time for sure. So,
Yes.
yeah.
Yep. But he in that program, and really, I mean, Casey
Yeah,
at Zenix, who
sure.
came from home bank,
Yep.
like they are why so many of us are still in this industry.
Yeah, it's he contributed a lot, no question about it. So talk about, before we talk about the main topic, what do you see kind of missing that sales leaders need to be thinking about that they haven't really thought about? We certainly hear a lot of conversations about AI and all of this, but what's the part that you don't see a lot of lenders really making a focus on?
Run a business. I think so few of us actually know how to run a business. Look, we didn't grow up wanting to or thinking we were going to have these careers in mortgage. That
Sure.
means many of us haven't been formally trained, nor have we had experience in marketing strategy. We don't
Mm-hmm.
understand the entrepreneurial operating system. We probably never read a book like Traction by Gino Wickman. We don't even have conversations with ourselves, let alone with our loan originators about lifetime value of clients and
Right.
customers. We don't talk
Mhm.
about cost to acquire a client or a customer, right? These aren't conversations we have. If we say LTV, we think loan to value, not long term value, right?
Yeah.
Loan to value, yeah, we know that LTV, but lifetime value, that's a foreign concept. And I mean, this has been going on for as long as you've been in the industry and I've
Yeah.
been in the industry combined times two, but they still think volume is what pays the bills.
Yeah,
And
they
it's like,
do.
no, profitability pays the bills.
Mhm.
Growth is required. If you're not growing, you're dying. That's in life and in business. And I think that's one of the core components truly lacking. And I don't think it's a 2026 thing. I think it's a 2016 thing, a 2006 thing, and even a
Right.
1996 thing, because most of us are salespeople and loan originators first. We were never business operators, yet
Hmm.
we've been given the reins, the keys, and the expectations that we can run a business without many guardrails, without much consulting, and even without proper management from our leaders.
Well, I think that's our next book, Dustin. So, because I agree with you, in fact, I write about it all the time. And I just think in our market today, how can you survive without being a professional? A professional is what you were really talking about. And so I'm with you on that topic. But what caught my eye was your LinkedIn article that you were talking to senior executive at a top lender regarding training and development. So, why don't you share part of that conversation? And then we'll talk about kind of what you see and certainly what I see. We'll compare notes.
Well, that particular conversation, I think the person was telling me that they had no desire
Right.
to bring people into the industry and train them up. That their desire was to go out, pay
Mm-hmm.
a pretty penny through the nose to acquire someone who already knew what they were doing, already had a
Mm-hmm.
following, and was guaranteed volume. Right? This
Mm-hmm.
particular leader was chasing volume, and I'm not anti that, but I was a little bit taken aback that there was no conversation about playing Moneyball. Right? Again, when I talk about lifetime value, when I talk about cost to acquire, I can run some math that says you're willing to go pay 40 basis points to onboard a $12 million producer, right? That's pretty much market standard going rate right now. So a $12
Mm-hmm.
million producer, 40 basis points, that means roughly $48,000 is what most IMBs are willing to invest to get that person to leave company A and to go work for company B.
Right.
But I'm thinking when you get that $12 million producer, do you project them to be a 24 or 20
Mm-hmm.
or $36 million producer? Do you have the infrastructure, the systems, the leadership, the mentorship that's going to provide them that opportunity? Or are you getting someone who is set in their ways, they're capped out in their ceiling, and they
Mm-hmm.
have minimal gas left in the tank? I would like to believe that when structured the right way, I can take that $48,000 and over a 3 year time span, I can guarantee myself better volume, more profitable volume if you let me grab someone and bring them into the industry. And
Mm-hmm.
yeah, that was if there was a thesis or a basis of the post, that
Mm-hmm.
was where I was angling. It's like when we play Moneyball, what
Mm-hmm.
from a standpoint of the mortgage industry, I can look at my top producers, I know who they are, I know what I'm getting, right? And for the most part, that's a volume play. I'm making less per loan.
Correct. Mm-hmm.
However, I need to have my top producers because it tells everyone else in the organization that we are a good organization and it
Mm-hmm.
lets everyone in the organization know what's possible. So
Correct.
I have them. I'm always going to have my bottom producers, and those are the men and women that honestly we have to get in there and introduce them to career
Mm-hmm.
opportunities outside of mortgage and remind ourselves we're doing them a favor. We're making a hard decision
Yeah.
for them that a lot of times they're just not brave enough to do it, although they know it's what's right. But then we have that middle 80%. And when you're playing Moneyball, it's truly a matter of how do I get this person from six
Right.
loans a quarter to nine, this person from 12 loans a quarter to 18, in which of my current originators are my future superstars? They have a
Mm-hmm.
high ceiling, they have gas in the tank. And how much time, effort, energy, and resources do I need to be allocating towards them? However, I think in totality, we as an industry lack that. We have our blinders on the wrong way. I coach LOs, put your blinders on, your head down and grind, come up for air, reassess and do it again. I think these blinders are more like cataracts and we're like blinded and
Mm-hmm.
blurred because we really can only see the 3 feet in front of us. And the 3 feet in front of us is I have this pipeline that has to get funded, that has to get delivered with minimal deficiencies, and I'm not worried about anything else besides what's in front of me today, which is like, this warehouse line, getting it clean, getting these loans sold. And unfortunately, I think that's a difficult way to grow and scale long term.
So talk about this whole issue. I agree with you 100% of what you're talking
Yeah,
about.
you're like, you're preaching to the choir, homegirl.
I
I
know.
got you.
We're talking the same
Yeah.
topic, and I just and even when you show them facts, and I'm sure that's what you do, that here's your impact of this approach, they don't seem to want to recognize that the game has changed completely, and it's not a game that model and the argument that I make, that model's based off of just reliving my capital markets. It's a declining interest rate environment. That's what that model, that's how that works, because you're just hiring lots of people, hoping some of them work out. Your top people, obviously you're hoping that you can get them. But the point is that you are talking about that model doesn't work in the current marketplace, which even if you listen to the MBA is projected to be pretty much purchase money with 6.5 rate. I mean, that's what you're talking about.
Mhm.
And
Yep.
so that model is a different type of model. So talk about that from your viewpoint, because I just think that the assumptions are old assumptions.
Well, you mentioned data. I love data. I tell people
Yeah.
numbers don't lie. People lie,
Yeah.
numbers don't lie. Now,
Correct.
statistics can be manipulated. Like, I'm not going to deny that. All of that said, look at the data coming from some of our data providers, whether it's my friends at Redder, my friends at Model Match, the minimum over at
Hmm.
MMI1, Ingenious, shout out to Jeff, like you name your favorite data provider.
Right.
And look at the data. If you're an IMB, you're losing headcount, right? You're losing headcount. Where's that
Hmm.
that where's that going? It's going to the broker channel.
Right.
Why is it going to the broker channel? Because the broker channel is attracting the newer, younger, growth minded, aggressive originator. The more
Hmm.
entrepreneurial, like that's where they're sliding to.
Hmm.
And I'm not one that's going to tell you the broker channel is better. I'm not one that's going to tell you the broker channel is worse. I don't believe any part of our industry is better or worse on a holistic standpoint. I love the mortgage industry. I love it for credit unions. I love it for call centers. I love it
Hmm.
for broker. I love it for banker. I love it for banks. Like, I think for each of us as professionals, as we go through the seasons of life and the seasons of our career,
Hmm.
then based on those seasons, you could have a preference to broker, a preference to call center, a preference to credit union, but you
Hmm.
can't tell me one is better than the other. But if one was doing something better than the other, the energy in the broker space is off the charts. It's
Hmm.
off the charts. The energy in the banking space, not so much. Energy comes from newer, younger, fresher. It just does. So,
Yeah.
the numbers and the data are telling me that the energy is shifting. If I want to flow or follow the energy, then I maybe have to figure out what are some of the things that that channel is doing that I'm not. And maybe I can start doing that so that I can continue to do everything I do well as an IMB, but also maybe grasp onto some of that energy. And I believe that is introducing people into the industry the same way
Hmm.
I was introduced into it in 2004. You were introduced to it in
Yeah.
1994, right?
Yeah.
Like,
Yeah.
it's time. You at one point were going to be an attorney.
Yeah.
You weren't going to run
True.
capital markets.
No.
You weren't going to run correspondent lending.
Yep.
Right. So yeah, I think that's where we're at. It's a changing of the guard. I
Yes.
retired from production because I believe even in the space that you and I occupy, there's a certain level of changing of the guard where, guys like me need to slide in and look at some other people that have been influential to me in my life. I
Hmm.
need to give them a hug. I need to give them a high five, a kiss on the cheek, a pat on the back, and I need to say thank you. And I also need to tell them, and we're going to be good. Like
Yeah.
we are going to be good. The industry is going to be good because of what you did, but also remind them that, hey, like we got you. Like
Yeah.
we can slide in and do what you did for hundreds of thousands. We can do that going forward for the next 10 years.
Well, you must be a soulmate because I'm with you on that whole topic. And I just think it's a topic within senior leadership that they view, and this is what it gets down to, is that they view making that investment is something that they view it as too long term, that they are worried about today more than 6 months down the road. And they view if I do it, that you will get recruited away. I mean, all of those thoughts are old thinking. Data doesn't support it. It's just really ridiculous that's the thinking that if I do this, they'll recruit them. And the point is, you'll get recruited away anyway. And I actually make the argument, and Dustin, I'm curious to your thinking, is that this idea of someone staying at a company forever, which is highly valued within our industry, has led to really static thinking because we really want people to come at certain points of their career, move to another point, and what you really are investing in is performance now. You're not investing for the future. You really are performance now, which is in your interest. And instead, they don't look at it that that's their responsibility. Is that what you see?
Well, can I tell you what I've experienced? Like I'm gonna quote our old General Secretary of Defense, Colin Powell. Colin Powell
Yep.
used to say, "In my humble experience," he didn't say in my humble opinion. In
Yeah.
my humble experience, like let me walk people through how this really works because I am someone who built a billion-dollar production division
Mm-hmm.
purely with this being our number one lead source, our number one strategy.
Mm-hmm.
Okay. In my humble experience, first I'm going to tell them this about they're going to leave and get recruited away. First, that's on you.
Yeah.
As a
I,
leader, that's on you.
yeah.
And you also had to put things in perspective. If someone left after 12 months, 24 months, 36 months, that's on you.
Mm-hmm.
Someone leaves after 84 months, celebrate it. Go back and look at their resume. They probably haven't worked anywhere for greater than 60 months and they gave you 72. That's called loyalty.
Yeah.
So, and the other thing I would tell that person who's worried about they're going to leave, be better. Be
Yes.
better. At the
Yeah.
end of the day, be better.
Uh-huh.
But then work it into your algorithm. Everything's an algorithm. Work it
Sure.
in algorithm. You already determined you're willing to pay whether it's 25 bips, 40 bips, 60 bips for certain originators between heightened basis points, sign-on bonuses, or even
Mm-hmm.
like some kind of a volume-based production incentive to get them to onboard. You can
Mm-hmm.
have the same exact math that you work backwards when you onboard someone who is a Henry, a high energy, not rich yet person.
Mm-hmm.
Except for here's the difference. Again, with my humble experience, when I hire a Henry and I assign a Henry a mentor, I can pay that Henry 90 basis points and
Yeah.
not 125. I can pay their mentor 25 basis points to be a mentor, which, by the way, you and I both know this because we're in the game. But when you mentor, you become better, right? Mentorship needs to be
Yes.
up and down, right?
Mm-hmm.
So we need to be getting mentored by someone above us, but also pushing our
Mm-hmm.
knowledge down. When we push our knowledge down, we become better. I mean, every one of
Mm-hmm.
my coaches will tell you they are a better originator since they started coaching
Mm-hmm.
than before they started coaching. So I look at it and say, if you want to play Moneyball with me and look at the numbers, my Henrys that I onboard will 100% work their tail off for 90 basis points. I'll give 25 basis points for them to have a dedicated mentor. When you add
Mm-hmm.
90 to 25, last time I checked, fourth grade math here, it's 115. 115 is less than 125. So I have net coming back to my branch 10 basis points. And
Right.
what was my financial investment to get that person like into the organization? Was
Mm-hmm.
it maybe I paid for them to go through one of your trainings, one of Casey's trainings, one of my coachings? If I added all those dollars together, what did that actually equal? And by the way, when you hire these people, you can be super selective and hold them accountable, which
Right.
you're not holding that 12, 24, or $36 million originator accountable. At least you're going to try to. Good luck. Right
Yeah.
after you paid them their $60,000 sign on bonus and you slapped on the 2 year clawback. I'm going to slow down because I'm finding myself getting up on my high horse a little bit. I'm going to step down from my soapbox, but yeah, that's what I've experienced when it comes to the numbers and the data.
Well, I'm with you on that whole topic, which leads to my next point is that what I think the gap is driven by that when you look at senior leadership at many of these companies, that they came up under different marketplace. And this whole issue of the age of the mortgage lenders really comes back to play with just repeating old strategies, which is all right, that's what they thought. But that's not our world today. And you raised a question that really, in fact, I I put a LinkedIn post today. Coachability needs to be really reviewed during the interview process because if you're not coachable in a world that's constantly changing, especially in the financial sector, you're going to be out of business. I mean, it's in essence, it's going to happen, maybe not today, but tomorrow. What are your thoughts on that?
On the leaders being coachable or their originators being coachable,
Well,
or all of the above?
I think some of the old thinking is at the top of the house, and therefore it comes down through where their viewpoint is really how they came into the business, which is a much different marketplace than it was 20, 30 years ago. That's not to say that all leaders are like that, but most of them are. And so we have this model that doesn't really work anymore. And then lenders are trying to compensate it by offering higher basis points to try to attract somebody. And so
Hmm.
it's led to this not recognizing we need a different model.
Yeah. Well, I would tell those people it's five of my favorite words when you string all five together. Nothing changes if nothing changes.
Yeah.
Right. I mean, if you're going to be in growth mode and you have your eye on the 2030s and not your eye on the 20 teens, then
Hmm.
you have to recognize that the playbook you're developing today and the plays you're running are to dominate in
Yes.
2030. It's not the playbook that I was using in 2008 or even
Correct.
2018. That's hard for some people. I mean, there's some people have a hard time changing their hairstyle or buying a new pair of jeans, and the jeans they wear have been out of style not once but twice now, right? I mean, but the fact of the matter is, if you truly care, now maybe you don't care, but if you truly care, you're going to have to start pivoting
Right.
and leaning into what the future looks like. And I do believe the future looks like bringing new men and women into the industry, but even bringing them in the right way. I mean,
Yeah.
like my biggest issue coaching loan originators is they are taught and they think and they act like loan officers. And anyone new that I bring in, I mean, they get told day one, it's your job to get a lead. What I tell them day one, the work is everything else you get to do once
Right.
you've gotten a lead. And by the way, I'm going to have a robot that's going to do most of your work for you in the future.
Hmm.
But if you can focus on getting a lead and becoming a great advisor and becoming an astute
Hmm.
financial representative in terms of
Hmm.
your advice, your consultative approach, become good at storytelling, more importantly,
Sure.
become the source of information for the local market that you serve. I'm like, that's what I need you doing. So we start with it's your job to get a lead. Then we talk about what the work is. And I even go one step further and I remind every loan originator, I don't care if you work for Bank of America, Mid Florida Credit Union, or Barrett Financial, or anything in between there. I will tell you, you work for you, comma, LLC.
Yeah.
And I think that mindset hasn't been ingrained in a 20-year veteran, a 15-year veteran, a 10-year veteran.
Hmm.
They
Hmm.
still think their value is they know the Fannie Mae guideline better than anybody. They can
Correct.
calculate VA residual income better than a lap underwriter can.
Hmm.
And it's like, no, y'all, like that's not your value any longer. Um,
Yeah.
I don't need you to be the best at disclosing or the best at doing lock extensions.
Well, I'm with you on that topic. And here's my big question. Do you think I get asked all the time, do you think things are changing within mortgage banking? And my answer is no, not really. I mean, to be honest about it, for the simple reason that, oh yeah, there's changes like, oh yeah, we talk about AI all the time and all that stuff. And some of the mechanical back office operational things, yeah, they're definitely better for sure. But the front side of it, unfortunately, our method is pretty much the same as it's always been. Try to recruit our way from other, pirating and all of that. That method has really happened. I don't see a lot of development of new people, although I certainly am seeing a little bit more, but not necessarily what I would call significant enough. So, what is your thoughts? Do you think it's actually changing
No, I think the only thing, no, the short answer
now?
is on the front end of things, no. Even, look, I'm a content creator, and I would
Yeah.
like to say I'm above average at creating content. And my friends in the loan origination world that are great content creators, 3 years ago, 5 years ago, we all were saying, you got to be a great content creator in order to do loans. No, you don't. No,
No.
no, you have to be a great networker. You have to have
Yeah.
a vast and robust database that you consistently market to. And yes, creating content and showing up online 1000% makes you more successful with doing the things that you've always been doing.
Hmm.
But like even that hasn't drastically changed. Now, I'm going to have a guy on my show who's going to tell me how he's generating 3 leads a day doing TikTok live.
Yeah,
That's really
sure.
cool. But you know
Yeah.
what? You know why he's coming on the show? Because he's one of only a handful that actually do that well. Malcolm Gladwell wrote a book about guys and girls like him
Yes.
called Outliers, right? He's an
Yes.
outlier. So no, overall, I'm not seeing it right now. Now, I'm also not like closing my eyes or sticking my head in the sand. I'm keeping my head on a swivel and I'm anticipating what's going to be coming down the pike,
Right.
what could potentially disrupt. And honestly, that is just if the technology can start getting to the consumer faster than we can, or if the
Hmm.
consumer starts bypassing the normal channels being real estate agents, home builders, financial advisors, if they start bypassing mom and dad or asking their best friend or their coworker for their recommendation, I think it could be disruptive. But right now, no, I'm not seeing a whole lot change. And yes, we will be utilizing technology to hopefully manufacture loans faster,
Correct.
manufacture loans quicker, more accurately, and more cost effective. I totally see that happening before I ever see like the front end of the work being disrupted.
So, do you see training and development? In other words, the way it works today is simple, is that what I see is that lenders feel that that's a cost factor for the loan officer to pay. And so are they providing it? They'll provide product information, computer training, and so forth. But when it really comes to upping their sales skills, that's left with the loan officer to go get that. And so the loan officer, especially the middle tier loan officer, you're asking them to make investments that's not likely that, not to say that aren't some, but it's not likely that they're going to view it like, gee, I don't know if I want to do that right now. I don't want to pay for it. So this model of outsourcing training and development up to the loan officer, that's the core problem where the company is not making any investment in the employee.
Yeah, I would agree with that, but I would say the core problem, if I really dug
Hmm.
deeper, the core problem is we work in an industry with zero accountability.
Well, I
Any
agree with that.
accountability we've ever had has been to compliance. It's
Yes,
been to,
correct.
regulatory checklists. And don't get me wrong, we
Hmm.
want to be compliant. Let's not get the company sued or
I
have
got
anyone go
right.
to jail for committing fraud. But we don't have much um, consistency when it comes to holding our associates accountable. We don't set expectations, and if we do, we don't then enforce them, which then makes it difficult because when we do go and spend money on training, well, I have to remind myself some will, some won't, but I have to say, who cares? Move on,
Yeah,
right? Not every LO wanted. I'm an equestrian. I'm going to be out in Wyoming riding horses next week for an entire week. And I promise you, because I've tried it, you can lead a horse to water. You cannot make that horse drink. We will be doing river crossings. And if
yeah,
my horse doesn't want to drink, he don't drink. Better yet,
yeah,
when my horse wants to drink, you think I'm going to be able to get him to stop drinking? No, we sit in that river crossing. I lift my boots up as high as I can in the stirrups and let him do his thing. So when it comes to our originators, I've tried it. I've tried to jam square pegs through a round hole. I was a miserable manager for about a decade until I realized it wasn't about the golden rule, it's about the platinum rule. Golden rule, treat people the way that you want to be treated. Well, I couldn't do that as a leader. I can't treat everyone as if they're me. They have my drive, my desires. If I
right.
could figure them out and I could figure out what drives them, what motivates them, that's the platinum rule, then I could treat them. So I have a
Uh-huh.
couple of different things I can do as a leader. Start holding people accountable. Unfortunately, I think that's even difficult to do. So therefore, I have to look at which of my originators are worth which level of investment do they want it, and then on
Correct.
a case by case basis I decide, do I invest fully, do we partner in the investment, or do I just go out and negotiate maybe an enterprise pricing structure, and a perk or a value of working at this institution is this particular training or coaching normally would cost you $300 a month, but because you work here we give it to you for $199. I think that's more of a case by case basis than it is
Hmm.
a one size fits all
Hmm.
basis. In my
Hmm.
perfect world, we could rewrite the mortgage industry. You would get a $60,000 base salary. You would get a car allowance. You would get a cell phone allowance. I would pay you 50 to 75 basis points. And the average originator funded 100 loans a year. Top producers were 150 and mega producers were 200.
Right.
Right? That would be my perfect. And those
Hmm.
men and women, I would provide tons of training to. They'd have lots of
Right.
accountability and daily
Right.
activity trackers, right? We would have that. But my last comment to all of the leaders that are tuning in is this: how you do one thing is how you do all things. Do you want to be the company that provides and say, this is our culture, this is who we are, this is what we stand for?
Hmm.
And pardon my French when I say this, and get your panties in the wad when 40% of your originators don't even take notice,
Right.
and 20% of your originators kind of
Hmm.
tiptoe. I almost use more choice words, tiptoe, but you have a third of them that are truly enjoying it.
Correct.
Ask yourself, do you want to be that type of company? What is that worth to you on the recruiting trail? What is that worth for you on the retention trail? And even the 40 that don't do it, do they still think more highly of your organization, even if they choose
Hmm.
not to participate? And then there should be a cost. That cost should be mitigated. It should be factored into your overall business model. And you should be able to come with a conclusion of, yes, I want to be that type of company. Yes, I do want to engage with a Pat or a Dustin or a Scott or
Hmm.
you name that person. And I may do one thing for this region, one thing for this branch, one thing for this
Hmm.
LO, but we are that company that believes in this and we
Hmm.
follow that pattern of success.
I with you 1,000%. But as I mentioned to you when I responded to your LinkedIn post, is what I have done is I have stepped into their role because they're afraid to say, no, you're not going to get training because you don't want to basically be trained. I've stepped into the role where they get interviewed by me before I will take them.
Yeah.
And I go through a sequence of, I call them my coachability questions, and if they
Mhm.
don't answer them right, I'm not taking them. So,
Yes.
and I think it's a sad comment that it's not happening internally, that the lender is not doing that internally because they know their employee.
I started doing that I've had great success with, and maybe you already do it on your end, is I have my signature boot camp that I've been doing for
Hmm.
over a decade. But what I started doing, especially when I have like an enterprise relationship, like an entire credit union or like an
Correct.
entire top 10 IMB, is I add an extra call a month and it's coach the coaches. So I'm
Yeah,
coaching the originators,
but the
but
manager,
I'm going
right?
to coach the coaches call. It's 1 hour of my time,
Yeah,
but I'm coaching the branch managers my curriculum. I'm
yeah,
coaching them what is being taught to their loan originators, what's being
right.
expected, and then I'm turning them into mentors and accountability partners. Because
Hmm.
honestly, the last thing I need is a bunch of LOs looking up to me as their mentor and me as their accountability guy.
Yes.
Coming in to teach or coach an entire organization, it should be about making the organization in totality better. And I do love what you said that you're doing, which I think all people should do, starting
Yeah.
internally before it goes externally, which is qualify.
Yeah, you got to
Qualify that
qualify them.
candidate. Yeah.
Yeah, they'll tell you if they want to be coached. I mean, and nobody wants to ask that question. I could talk to you for hours. I agree with all that you're saying.
I can
So,
talk for hours,
well,
but
you're doing
but
a
I think
great
we both
job.
have places to go, don't we?
Yeah, we do. So, just share with our listeners a couple takeaways for today that, what's the one thing if you're wanting to make your culture a training and development culture, what is it that you should do?
Probably this is self-serving to both of us. Hire an expert.
Yeah.
You're great at what you do. I mean, I'm a big fan of this saying. I stole it from Dan Martell. It's 80% done by someone else is
Yeah.
100% awesome. When you read his book, Buy Back Your Time, you
Yes.
learn those type of concepts. I
Mm.
promise you, the fees that you pay to people like Pat and I, when you compare it to what
The-
you'd have to pay to yourself, what you have to pay to your team,
Correct.
create the content, deploy the content, teach the content, your ROI is actually with an outsider. So at a minimum, you bring in an outsider, even if you pay them long enough to then take their best things and implement it inside, you can gamify it. There's nothing wrong with that. But I think
Hmm.
step one is to consult with and pay an outsider to come in. I think step two is you really sit down introspectively and say, who are we as a company
Right.
and where are we trying to go? And then answer, how am I going to get there? And then
Hmm.
is your current solution still the best solution? We
Hmm.
do this with homeowners all the time. The loan I did for you 5 years, the reason why I do an annual mortgage review is I have to determine, is that still the best home loan for you based on the
Hmm.
market, based on where you are in life, based on what your home is worth? I think we as leaders have to look at our mortgage operation and say, is my current plan the best plan, or is there a better plan that I should be leaning into?
So, Dustin, how can our listeners get a hold of you to continue this conversation?
Okay, so the easiest way, I'm like crazily accessible on LinkedIn. First name Dustin, last name Owen. That is by far the easiest. Like, I love it when people follow us on Instagram. We are at the Loan Officer Podcast. And if you like free coaching and free sales training, I have an entire YouTube channel with over 1,000 videos, 33,000 subscribers. I tell people, go to the YouTube channel, go to YouTube and type in the Loan Officer Podcast, or I think our technical handle pad is at TLOP Entertainment. But I
Hmm.
would say LinkedIn for me, Instagram just because it's a fun account to follow. And then the YouTube channel is by far the most subscribed to coaching and sales training channel in our industry. So go check
Hmm.
that out. I've been told it's not that bad.
You- You're being shy. And so I highly recommend that you connect with Dustin on his LinkedIn. He writes, his blogs are fabulous, and I follow him myself. So I highly recommend reaching out to him. And I want to thank you, Dustin, for sharing all your wisdom. You've been fabulous today.
Well, I thank you, Pat. I appreciate this connection and I look forward to meeting in real life sometime soon.
Yeah, and I knew after you do your vacation.
Yes, there we go.
All
Awesome.
right.
Thank you.
Thanks so much. Thanks for joining us today. And if you're looking to become a more effective sales leader, check out the Mortgage Manager Mastery and the new companion workbook at mortgagemanagermastery.com. Until next time, keep learning and keep growing.